Netflix earnings beating expectations, reporting 89 cents per share versus the 68 cents that were expected. Revenues of $4 billion for the quarter, right in line with estimates. But the reason we see that stock shooting higher after hours is because of the addition of far more subscribers than expected. The company had the net additions of 6.96 million new subscribers around the world. Expectations were for the addition of 5 million new subscribers. And also, if you look at the forecast for net additions for the fourth quarter, the company is guiding to the net additions of 9.4 million new subscribers in Q4. Analysts have been projecting the addition of 7.6 million new subscribers. Now, for Netflix, because these subscriber numbers are so important, just to break it down, U.S. streaming net additions, 1.09 million. Analysts have been expecting about 670,000. International streaming net additions, 5.87 million. That's more than a million more than expected. And also, if you look at the guidance for Q4, stronger growth both internationally and in the U.S., particularly interesting because there was concern about sort of saturation of the U.S. market. Now, if you look at the earnings number, Q4 forecast for EPS is 23 cents, which is lighter than expected. But it looks like some of that may have moved into Q3 with that big beat of 89 cents per share. And just moving through this letter from shareholders here, CEO Reed Hastings saying this quarter we under forecasted memberships. The total net additions of 7 million was higher than the forecast of 5 million, and we represented a new Q3 record. The variance relative to forecast was due to greater than expected acquisition globally with strong growth broadly across all our markets, including Asia. The company announcing in its letter to shareholders that they're going to start breaking out paid net additions and total net additions, making it clear that they're not going to be accounting for or making it clear how many of those additions are people using free trials. I'm going to continue to dig through this letter here, and we'll be back to you guys with more. Both?
Julia, thank you very much for that. Netflix share price up about 13.5%. Let's get reaction from Charlie and Mike. Mike, clearly the sub number, which disappointed last quarter, has positively surprised.
They needed to do
this quarter, but also the EPS, even though revenue's in line, the profitability's really come through in an attractive way as well.
It did. I mean, a lot of that is probably how they account for their content costs on an ongoing basis. So there is some leverage to it when you actually sign up more paid subscribers. Paid subscribers up 25%, paid subscriber revenue. So I do think, obviously, blasted through their own forecast. It was interesting because last quarter when they missed so bad, everyone scolded the company for not having a handle on their own business and their own marketing plan because they fell short of their own forecast. Well, here they way exceeded their own estimate. So maybe they still have a planning problem or a projection problem, but in this case, it's in the positive.
Or it could have been
not
a blip,
problem.
Right?
It's just a dynamic company. They're growing so fast. You're going to have accelerations along the way.
With a lot of new content coming out this quarter, I guess it shows how geared they are to those sorts of new shows or new series of hit shows coming out.
Which is both the bull and the bear case in this sense, right? You've kind of had people very much levered to testing out Netflix because of a particular new piece of content. So, I mean, at this point, I think people are going to be reassured at the business model. At 425, I believe, is about the all-time high. With Netflix.
Yeah, I mean, the stock was still down going into earnings, 20% from the last earnings. So this will go a long way. I always find it interesting that Netflix, in the letter to investors when it releases, comments on the competition and the crowded space that we're seeing. And they name names. Apple, Amazon, and others are investing in premium content. They actually give a shout out to the new Fox within linear TV, saying they appear to have a great strategy, which is to focus on sports and news, and they're not transformed by basically what we're doing, on-demand viewing and personalization. So they're more resistant to the rise of the internet. But clearly, when it comes to the competition, Netflix continues to lead, which is always sort of in the back of investors' minds. Apple and Amazon and Hulu and now Warner Media and Disney are all trying to go after the same thing.
They're getting, well, first of all, getting ahead of the obvious questions about what could slow down Netflix and trying to also take kind of the high road where they're saying we're very customer friendly. We're just going to give our customers more of what we think they want. And also emphasize, I think, along the way that they have such a head start.
And I think they're going to spend a lot of money doing it.
And the whole investment proposition with Netflix, good or bad, is what's the value of that vast head start that they have?